Welcome and afternoon. Thanks for giving up your time and joining us this afternoon. My name is Lisa Martens. I'll be your host today. We're joined by a stellar lineup of guest hosts as well as experts in finance. So if you're an e-commerce startup or if you are already running your e-commerce business and you have questions around finance, then you have come to the perfect webinar to get you more confident and just work on your financial literacy. So today, without further ado, I'm going to get into the webinar. We will be taking questions as we go throughout the webinar. So if you have any questions, put them into the chat, which is available on that control panel. My name is Lisa. If you missed it in that start, I'm the head of customer success and partnerships at Workit Spaces. I have the pleasure of dealing with our e-commerce space in our 3 hubs in Alexandria and New South Wales. And to let you know, we will be recording this webinar and you'll get a copy of this webinar sent out to you via email. It'll likely come to you tomorrow, and we look forward to having your feedback. At the end of the webinar, we'll have a short survey so that you have a chance to provide some feedback around what you loved and what you want to see in future e-commerce and finance webinars. Just a quick introduction around Workit Spaces. We are a business that is ourselves, we think about ourselves as an e-commerce startup. We help businesses, e-commerce businesses to thrive. We're really focusing on helping e-commerce businesses that have a range of ways to pull together a digital platform. It's quite easy these days to look at a variety of storefronts and get your sales channels running and perfected. However, it's often very difficult to scale your physical operations, which if you're running an e-commerce business, an online business, you know that there's a lot more than the beautiful front end and the sales experience. You know that you often need office space, showrooms, warehousing, and logistics. And these are very difficult things to pull together, and they're tricky to make scale. So Workit Spaces was founded with the idea that we want to help sustainable e-commerce businesses find the right mix of that physical element, as well as offer you those growth-based services like photography studios. We have integrated loading docks, and we have a digital agency to help you grow and scale. A quick look at our spaces. This is what you're seeing here is our Burke Road Alexandria hub. A beautiful big space which has around about 100 e-commerce businesses. We have an additional 2 hubs in Alexandria, and we're about to grow even further. So if it looks like something you're looking for, we'd love to have a chat with you. But today what we want to focus on is helping you understand what options are available to you when you're looking to perfect and select a finance option for your business. We want to help you cut through the noise because, as we know, there's a plethora of opinions out there, and as a business leader or a business founder or a team manager, people always give you those opinions, but what you really want to know is you want to be confident in your financial strategy. So we're helping you to look at different options that you can make available for your business at your current stage and also for your future stage of growth. So I'm really excited that we have Stephen Duke. He is the Wayflyer country manager. Stephen has been at the forefront of online businesses and helping them to scale and to accelerate their success. He focuses on finding the right funding, and he also finds, helps you to identify the right financial insights that help you to make really well-informed decisions about where you are and how you can best use your finances to grow and to make your business, operating sustainably as well as with resilience, something that's really important when there's any time of uncertainty. So, Stephen, you should give us a little sense of, your background and what you're going to be chatting about today.
Yeah, awesome. Thanks, Lisa, and hey, everybody. Really nice to be here. As Lisa mentioned, I've kind of been working in e-commerce for a while. So I used to work for an e-commerce company where I ran marketing and all of growth there. And we grew from probably about 20 people when I joined up to about 300 people now, and so it's a huge company. I then moved to Wayflyer, and what we do at Wayflyer is we help e-commerce companies to grow. And the main way we do that is by providing them with funding. And so I've spoken to literally hundreds of companies at all stages, people who are literally just starting out their company to people who are doing, tens of millions of dollars of revenue through their online store every year. And I've seen what has worked, and I've seen hasn't worked and all the different options that are available. And so that's what I'm excited to share with you all today.
Thanks, Stephen. We also have the great pleasure of having the brother and sister duo who have launched, and they actually pivoted from a traditional bricks and mortar store. Mr. Poolman is, your one-stop online store for anything pool related, and they pivoted from the traditional bricks and mortar to an online store which also offers click and collect. So we're joined today by Tom and Nat, the head of e-commerce, and they both, between them, they cover both operations and marketing. So they're perfectly positioned to give us real insights around what it's like to go through the whirlpool of funding options. They've learned some hard lessons along the way, and then they found the right fit. So Tom and Nat, thanks very much for joining us today.
Thanks so much for having us, guys.
Yeah.
Pleasure to be here.
Thank you.
Great. Well, we are going to start with a poll. What we want to know is that we could talk about confidence and how important that is, but we want to know where you sit right now. So we're hoping today that we'll be helping you to become more confident, but we want to see where you start out. So you'll be able to go over to your control panel, pick up that poll and let us know. And then what we will be able to show you afterwards is how you sit with others as well.
Awesome. And I guess, Lisa, can I take over from here in terms of?
Yeah, I'd love that.
Oh, we're updating live. That's awesome. I guess not Tom. Like on this question, how confident are you, and how has that kind of changed over your journey through the business?
Yeah, well, it was a learning curve, which I think is common for most people. Everyone always says that you need to know your numbers, which obviously you do, but it's also so hard understanding your numbers, especially when you wear so many hats in e-com, as most startups do. Most people are their own marketing company, they're their own picker and packer, they're their own inventory. Like it's all, you wear so many hats, and it's so easy to get lost into stuff that's irrelevant without scraping it back and understanding the finances of your business. So we are now thankfully quite across our finances. We have learned some hard lessons along the way, which stings, but again, I think in hindsight, if we had it all handed to us, we wouldn't be where we are today. It's those hard lessons that take to get it to where you are.
Yeah, definitely. I think hopefully we get to share some of those lessons with the crowd who are listening in today. But wherever you landed on this poll, I think that hopefully by the end of today, you'll leave feeling like completely confident in terms of how to understand the finance of your business and also like make important decisions, right? Sure. And so specifically, what you're going to learn today from the conversation that I'm going to have and from Nat and Tom is 4 things. So one is, why this even matters, right? Why is this important? And we'll go through kind of some example stories of that. The second bit is understanding the financial anatomy of your business. Because if you don't understand how finance works at an e-commerce company, it's very difficult to make decisions. And they're also very different to other companies that are out there. The third one is some principles for financing your business. Because again, you can't make those choices unless you have some principles around what you should be looking for and what you should be avoiding. And then finally, we'll actually get into the 7 options that you have and how you can go through a process to choose those options depending where you are in kind of the life cycle of your company. So they're the 4 things. We're going to go through them. I'm going to bring Nat and Tom in throughout the conversation to kind of hear about their experiences and hopefully some of the lessons that they've learned along the way as well. And as Lisa said, if you've got questions, you can just drop them in the chat and we will get to them.
Perfect.
Awesome. So first of all, why finance matters. So I think you can have a great product, you can be amazing at marketing, you can have a fantastic brand, you can have a beautiful online store, you can be running your supply chains, your operations incredibly efficiently. But if you run out of money, it's game over, right? And ultimately, that is why businesses fail. Businesses fail because they run out of money. And on the next slide, that is literally that statistic, right? It's the #1 reason that businesses fail is running out of money. And so, like, finance is super important, because you can have all those things right, but that's not always enough. We jump on to the next slide. So let me tell you a little hypothetical story about this guy called Dave. So Dave founded a company which had eco-friendly cutlery, and he had made some nice products, and they were starting to sell really well. And he was like, well, how am I going to get money to grow this thing? So in his first year, he raised some money from his friends and family, and he gave them a share in his business for that. In the second year, he decided to take some debt from his bank. Now, his bank asked him to put up his house as collateral for that, but he thought he really needed the money, so he's like, okay, whatever, I'll put up my house as collateral. And in the third year, he managed to go and convince some venture capitalists to actually give him some money so that he could grow his business further. So, you know, from the outside in, he's been managed to raise a lot of money. He's probably growing his business really well. But, you know, where is Dave now, right? Like that's the question. How has this actually turned out for him? And so if we jump on to the next slide, we can see that unfortunately for Dave, although his company has been growing, he only owns 25% of it. So for every dollar a property makes, he only keeps 25 cents, right? That's not great considering the amount of effort and hassle and work that it is to run this company. And he also has a lot at risk, right? Like his house is at risk, and he's had to use that for collateral on his loan. And like that causes him a lot of stress, right? Because he knows that things don't go well. Not only is he losing his business, he's losing his family home as well. And then finally, by taking on venture capital investors, he's had to give up a lot of control over his own business. So he's had to give people, you know, maybe a seat on the board and voting rights. And so he can't always do what he wants to do. And that's, you know, stressful for any entrepreneur, but also for somebody who has, you know, a mission for their company, right? It's their baby. That's why they started it, was to achieve this mission. But now if you lose control over it, you have other people telling you what you can and can't do. And that's not a good situation, not a situation that you want to be in, right? So I think, you know, the takeaways from this is that he had a great company, but, you know, there are some choices he made along the way that probably seemed good at the time, but because he didn't fully understand the choices and the impacts of what he was making, led to a situation that, you know, he probably wouldn't have liked when he started off. So that's why finance is important. It's the number one reason businesses fail. And also, if you make the wrong choices, you can end up with a set of outcomes that you definitely wouldn't want when you're going into it. So the next thing that we need to do is to understand the financial anatomy of your e-commerce business. And so what do I mean by that? Basically, you need to understand how finance works at an e-commerce business, because it's very, very different to a lot of other businesses. As Lisa said at the start, there's lots of information out there. If you Google it, you'll find 101 articles, how to finance your company, how to fund your startup, whatever else it is. But a lot of it is not tailored to e-commerce. It's maybe relevant to software companies, or maybe it's relevant to other small businesses like a restaurant or a cafe, or a service-based business like an agency, a marketing agency. But those companies have a very, very different financial anatomy to an e-commerce company. So let's understand what the financial anatomy of an e-commerce company actually is. So next slide, please, Lisa. Before we jump into that, we've got another poll, which is to ask you guys what your biggest financial challenge is in running your e-commerce business. And as that pops up, Nat, Tom, what's your biggest financial challenge? And again, how has that changed over the life cycle of the company?
That's a great question. And I feel like to start with, you're really not sure, you know, well, which one am I? I'd say from personal experience, it's been profitable and sustainably growing your revenue. Revenue is thrown around as such a vanity metric. We can bring you traffic, we can bring you revenue, and they both sound good, but what are your frameworks like in the background? What is your gross profit margin? How much are you actually taking home at the end of the day? You can have a banger 6 months and then find out later that that's actually not your money because you owe it elsewhere. You're not profitable. So it's actually a balancing act of all three. but I'd say definitely B was getting profitable and managing those costs correctly, and then managing your cash flow, and then focusing on revenue.
Yeah, super interesting. And you've got a bit of a split across the participants as well, which is really interesting, but also not surprising, right? Because you ultimately need to do all of these, right? Like you can't just forget about growing your revenue and just be profitable, or vice versa. And so you do need to keep all three going, but at different stages of your company, one might be more important than the others, right? And I think that's kind of your guys' story, is like, okay, probably at the start, if you're starting off from nothing, you're probably like, right, I've got to get some revenue on board. But then once you start to get revenue and you realize, okay, great, I'm growing this thing, but actually I'm not taking home anything at the end of the year, then it shifts a bit more to profitability. And so I think, what the takeaway from this is that, like, you need to understand the challenges that you have and how they fit into, like, what's kind of your primary challenge depending on the stage of the business that you're at. So let's jump on to the next slide. So coming back to that idea of the financial anatomy of an e-commerce business, e-commerce businesses have a couple of strengths and a couple of challenges or weaknesses. So typically, they have high gross margins. So on the product that you sell, especially, this is especially true for direct-to-consumer e-commerce businesses. You can often see, like, almost as high as like 80 to 90% gross margins on the products that you sell. It's also very scalable. If a product takes off and there's a demand for it, it's relatively easy to scale up that product, right? It's especially when you compare it to other businesses, like say an agency, a marketing agency. You are ultimately tied to the people that you have working in that business, and so if demand takes off, you got to go and hire like a load of people, and that takes months. You got to train them, and ultimately years, right? So whereas e-commerce businesses are very scalable compared to other businesses when you get it right. But there's a flip side. The two challenges are, it's a bad cash flow cycles, and what that means is that most of the time you have to spend a lot of money before you get any return back from it. Specifically, that's driven by spending on stock, buying stock, and paying for marketing. So you might have to buy your inventory today. It mightn't get delivered for 2 months, and then you might only sell it another month after that. So you got to put out the cash today, but you're not going to get it back, anything back, for 3 months. And that's what we mean by bad cash flow, right? Again, that's compared to other companies. So say software company, very often they will sell a year subscription up front. So they've actually got the flip. They get all the money up front, and then their costs come afterwards, right? So that's the challenge of an e-commerce business. And the second challenge is that usually you don't have that many assets. And this is especially important when you come to talking about getting finance. A lot of the time, especially banks, will look for assets as collateral against any finance that they give you. But e-commerce companies, tend not to have that many assets, right? Like the assets are the stock maybe that you hold. Like maybe you have a warehouse, but typically, again, it's not like a restaurant where you actually have like a building or something else that you can put up as an asset. And so, what does this mean? Basically, this means that there are a specific set of challenges that an e-commerce business has that are unique to e-commerce businesses. And it also means that it changes the options that are available to an e-commerce business, primarily driven by the fact that you don't have that many assets. But we'll get onto more about that later. Cool. Let's flip to the next slide. So hopefully now we understand why this finance thing is important, right? It's the number one reason businesses fail, and you need to get it right because it can end up with some bad outcomes if you don't, right? You also have a bit of a better understanding about the financial anatomy of an e-commerce businesses, the strengths and the weaknesses. And so what we're going to talk about now is the principles for financing your business. And there's really 3 principles that we think about and that I've found all of the companies that I've worked with, that when they start thinking around these 3 principles, it's actually it really helps them to make better strategic choices when it comes to their finances. And so the 3 are protect your ownership, match finance to your needs, and minimize the downside risk. And so what do I mean by those? So protect your ownership. It's very tempting to sell part of your company as a way to raise finance, right? Especially now you see everybody celebrating raising venture capital money, raising money from other sorts of investors. It's it's almost become a thing in the industry now that this is what people celebrate, not necessarily the success of the business. But there's 2 things wrong with this, or not even wrong with it. There's 2 downsides of it, right? One is that it can turn out to be very expensive in the long term. If you sell 20% of your business today, and your business is relatively small, that might seem like a great deal for you. But what you need to realize is you're giving 20% of every profit dollar that you're going to make forever, right? Like this is a irreversible decision. Once you sell part of your business, that's it. You've given up that share of your future profit and you aren't getting it back. The second problem or challenge with it is that you do sacrifice a bit of control. And I know like a lot of people start their own e-commerce businesses because actually, maybe they were working in like a big job where they had lots of people telling them what to do, or actually this was their mission, and they had a vision that they wanted to pursue. And the last thing they want is somebody else telling them that they can't do that, or that they need to do something else instead. But if you sell part of your business and you give up ownership, that often comes with the trade-off that you're also giving up a bit of your control. So it's really important to protect your ownership. The second one is about matching finance to your needs. And so we think about this in kind of 2 stages. So one is your needs in terms of what stage of the business are you at? Are you just starting off? And this comes back to our challenges where, your need is actually to get a bit of first revenue, right? To maybe develop some products, or is actually your need that you're already a profitable, company with lots of revenue, and your need now is actually cash flow. Because you need to and this is kind of what Tom and Nat were talking about earlier, right? They're kind of now getting to a stage where, perhaps maybe their biggest challenge is around getting profitable, but also managing cash flow. And so it's a very different need when it comes to their finances. And then the third one is about minimizing the downside risk. So this comes back to the story earlier that we saw with our fictional character, Dave, right? Like you always want to think the best, especially if you're an entrepreneur and you're running your own company, right? Like you have to think of the best possible outcome, otherwise you'll probably drive yourself crazy. But you also need to consider, what happens if this doesn't go well? And minimizing the risk in those situations is really important. So in Dave's scenario, he put up his own house as collateral. And again, that's his decision, like that's fine, but that does come with a downside risk if it doesn't go well. And so these are the 3 principles that when you think about like assessing a finance option, if you're thinking about getting a loan, if you're talking to an investor, if you are thinking about running a crowdfunding campaign, you can use these 3 principles to try and figure out if it's the right decision for you. Tom, Nat, is there any other kind of like principles or almost like rules of thumb that you guys have found helpful as you've assessed different options for financing?
Yeah, sure. I think what it stems back to is on one of those first slides is knowing like your finance structure, like your profitability, like your unit costs, your unit economics. So what it costs you to land a product if you are bringing it in from China. Obviously, you can get stung very quickly with import duties, inland shipping taxes or charges within China, getting it to port. If you don't get quoted the right way, if you're getting it X works, then you're going to be hit with inland shipping charges. So it's really getting back to your actual unit economics, because if you get that wrong from the start, it's just going to be a domino effect, or you're going to be chasing from the very start. That's kind of one thing that we've learned the hard way as well with buying products directly from manufacturers in other countries, is the logistics, the shipping, the taxes, the duties, not accounting that for when you also are trying to get capital, whether that be through a lender of last resort, a bank, or you're mortgaging your property, or you're taking on venture capital, is not knowing those numbers and then getting caught out and then having to go back to the lender or to the investor and say, hey, look, I've made a mistake. I actually we're negative or we need more money, it's a lot harder conversation to have than putting that harder work in initially and making sure you've got everything dialed.
And following off that, it's not sexy, right? So it's not always the most sexiest, shiny part of the business to get deep in the spreadsheets and get deep in the figures, but it's just like building a house, a relationship, a business. The framework is important, and that is your framework. And then when you go off, you land your goods, right? And now you need to set budgets, targets. You need to figure out how hard your dollar needs to work. So what your return on ad spend is going to be, what your ROI is going to be. And all of that derives from your base numbers. So your gross profit margin, which comes directly from your cost of goods sold. And then when you look on Google, when you look to find all of these, figures, and it gives you the equations, you've got them ready and waiting for you in those spreadsheets. You know where you're at financially.
Yeah, I think that's such a great point. Because you probably get a very different answer. Like your first answer when you do like the high level approximation around your cost of goods sold is probably very different to the answer that you get when you actually get in and run all the numbers, and you see how it's very different for different products, right? So maybe the high level assumptions, don't hold up for every product.
Every assumption is wrong until it's proved right, and everything can always be proven through the data, through the figures.
Yeah, exactly. I feel like we could probably do an entire session, right, on this kind of understanding the baseline, the numbers, and your cost of goods sold and your unit costs. It's a super important area, and as you said, it's not something you can just solve on the surface, right? But that's a great principle. Like I really like that. Kind of, it's almost that you could bundle it into that financial anatomy sense, where it's like, okay, there's some rules for e-commerce businesses in general, but there's also the specifics of your company, and you need to understand what those are, because they do affect the options that you should take.
They affect all of your options.
Exactly. And I think just going off that too, Stephen, like whether anyone watching this video or people as a whole are trying to get funding for their business, e-com or not, whether it's 10,000, 100,000, $500,000 of funding, whatever you want to call it, if you don't have your numbers right, you'll just go through that very quickly. Like $500,000 sounds like a lot to all of us, but we know that you can burn through that quicker than you've ever imagined, and you'll be left standing going, where's it gone? Like it literally doesn't make sense, but it just shows that you don't know your numbers. So it's one thing to be able to secure funding at whatever that amount may be, but if you're not spending it sustainably or correctly in a calculated way, well, it's no good. Like you're just going backwards from the start.
Yeah.
Let us know if you're listening, if say the cost of goods sold and your fundamentals, you getting down to your unit costs and forecasting at that base level. If that's something that you're interested in hearing about, let us know in the comments, and it might be coming up in the next couple of webinars. Yeah,
definitely. Okay, cool. So let's move on to the last section. So this is really where it gets interesting, right? So this is where we actually talk about the options that you have and how you can go and choose them. And so hopefully if you're listening, you'll be able to say, okay, this is the stage of business that I'm at. I understand the options that are available to me and understand the pros and cons, right? So that's really kind of the goal of this section. Awesome. So let's flip on to the next slide, please, Lisa. And one more. Cool. So there's 7 options. Each one has pros and cons, right? Like the purpose of this is not to say that there is no one right silver bullet here for financing your e-commerce company, and they change depending on what stage of the business that you're at, right? But we've got 7, and I want to run through them quickly and tell you briefly what they are and also the pros and cons, right? So your first option is to bootstrap it, right? And this is what a lot of people do. They just use their own funds, the money that they make from their sales, they put it back into their business. And that can be like, that's great because it's pretty much no downside risk because it's only the money that you're getting back from your business anyway. But usually you're limited by the amount that you can actually generate. And so there's usually a ceiling to how much you can actually do with bootstrapping. Secondly, you've got your friends and family, depending on who your friends and family are. But very often, especially at the early stages, we see people raise a bit of money from their friends and family. Usually that's often in return for like some sort of ownership stake in the business. And so you do get, the downside of it is that you are actually selling a part of your business, right? And so that's kind of future profit that you are giving up. The second one is credit cards, right? Like this is like lots of businesses will use their credit cards to finance, especially kind of like short-term options, especially as they're small and growing. We find that this can work quite well for some options like paying for your marketing spend, right? Because at least you do get the 30-day payment terms on your credit card. But again, the kind of limitation or the challenge with credit cards is that there's only so much, right, that you can put on it, and so I've spoken to so many companies who are like, hey, I've got these amazing Facebook campaigns that are giving me 10x return on ad spend, but I've tapped out my credit card. I wish I could spend more money on them, but like I literally can't because I've maxed everything out, and so eventually you do hit this limit with credit cards. This isn't just a side note, but if anybody is paying for their some of their Facebook or Google ad spend using a credit card, specifically one issued by the Australian banks, there can often be charges associated with that, that you may or may not see. So it's something that's worth looking into with your bank, because oftentimes they're actually international transactions because you're paying Facebook's US entity, and so there's sometimes a few sneaky percentage points added in there by your bank, that you might want to check out and see if you can save yourself a few bucks. The fourth option is crowdfunding. So this is where you run a campaign. It's basically like a really big pre-sale. So you're basically saying, hey, look, I'm going to have this product in the future. If you pay for me now, I promise I'll deliver it to you. This works really well when you've got a very innovative product, right? So something really that makes people go, wow, this is so cool. I want that so bad. That looks amazing. I'm willing to wait like 6 months or 12 months to actually get the product. But to do it well, or for crowdfunding to be successful, you not only need that really innovative product, but you also need to invest quite a lot into running a good crowdfunding campaign. Right? If you go onto any of these crowdfunding platforms, you will see hundreds who have raised, $20, because they just didn't develop good enough creative. They didn't really push it hard enough. They thought it was just, I throw it up on the side and I get, $20,000. How hard can it be? Again and again, I see that crowdfunding only works if you've got a really innovative product and you really invest into like good creative and running like extremely good crowdfunding campaigns. If you want to see some good examples, there's a company called Lab Fresh, and they do a stain resistant shirt, so you can spill red wine on the shirt and like it doesn't stain, and of course that's awesome because you imagine like the great videos you can make around that, and it's great for crowdfunding. So that's another option to you, but again, probably more if you have like that innovative product and you're very good at creative. The fifth is venture capital. So pros of venture capital is you can get a lot of money upfront, right? They have, there's no kind of paying it back, right? It's an equity investment, and so they get a stake in your business, but ultimately, if there's not too much downside insofar as if the business ends up not working out, you don't have to pay them back. The downsides are, it can be expensive because you're giving up that share. Also, you're giving up a bit of control. The thing to be very aware of with venture capital investment is that they need you to become massive for them to make money, right? And so that's important for two reasons. One, you can waste a lot of time trying to get venture capital investment without realizing that actually they need you to be like a multi-$100 million business or $1 billion business, which like realistically you may never become, right? So you can waste your time trying to convince people of that. The second thing is that if you do get VC investment, like they're going to push you for really, really fast growth. Like they're going to need to see every month, every year, significant month-on-month, year-on-year growth, right? And maybe that's what you want, right? Maybe that's the kind of the pressure and the level of growth that you want. But actually, if it's more about a finding sustainability and like a lifestyle business, and then that may not be for you, right? And so I think that's another really important thing to think about there. 6, we've got bank debt, right? Everyone's pretty familiar with getting loans off the bank. Tom, Nat, you can probably talk to that a bit as well. The downsides are usually that you have to put up assets if you have them, some form of collateral, all right, like a personal guarantee against them. So you do have that downside risk, and also they can be pretty hard to get, especially as you're starting off, if you're a small company. And then 7, you got revenue-based financing, and so you may have heard of this. I'm not sure. It's kind of a new type of financing for e-commerce that's come around the last few years, and it's what we do at Wayflyer. And it's for people who have, reached that growth stage of their business, so that they've got, they've already got some revenue coming in, the business is working, they have a few marketing campaigns that are working for them well, and they want to grow, but they don't want to do kind of any of the other 6 options. They don't want to take on debt, they don't want to take on investors. And so how revenue-based financing works is that you can get cash, you can get money, which you can spend on your inventory, your marketing, whatever you need to spend. And then you pay it back as a percentage of your revenue. So the idea there is that because it's the repayments are as a percentage of your revenue, it's really flexible. So if you do a good week, you pay back a bit more. If you do a bad week, you pay back a bit less. And there's no collateral, there's no guarantees, and you don't give up any ownership. So we find it work really, really well for those companies who are in the growth stage. Okay, that's a lot, right? 7 options, lots of pros, lots of cons, right? But on the next slide, there's kind of a helpful way to think about this in terms of where your business is at. So you might be able to look at this chart and say, okay, where does your business fall? Are you just getting started? Are you maybe like pre-revenue? Or maybe you're making 1 or 2 sales a month, right? If you're only getting started, you've got these few options available to you, right? It's going to be very difficult to raise venture capital or get a bank loan if you don't even have any sales or any assets yet. If you're in the growth stage, so you've got some revenue coming in every month, it's pretty predictable, you've got some marketing campaigns, you may be able to raise venture capital, right? If that's what you want to do, if you've already shown that you have some traction there. And also the option of revenue-based financing becomes available to you because you've got that revenue that you can use to pay back the revenue-based financing provider. And then ultimately, when you hit scale, so this is, you're doing, a few $100,000, few $1 million, you may now have the option to get a loan from a bank. And also the revenue-based financing option doesn't go away, right? So that will stay with you as you grow. So hopefully this is a helpful way to look at it. You might say, oh yeah, that's where I am. These are the options. I understand the pros and cons, and be able to make a choice. Cool. I have one more slide and then I'm going to stop. So we talked a lot about, understanding the importance of finance, the anatomy and the different options that you have available to you, but how do you actually select one, right? Like, depending on where you are. And so there's kind of 5 steps that I see to do this. One is like, what is your actual goal for the company, right? Is this going to be like, do you just want to have this as a side hustle, right? Maybe makes you like a little bit extra money every month. If so, that's great. Or do you want to like take it to the moon and be $100 million business, right? You need to know, you need to have an idea of where you want to go first. Second, where are you now on that curve we just saw? Where do you currently sit, right? The third one is the potential. Like, can you be that $100 billion business? In which case, venture capitalist investors might be interested. Or actually, is that just not really within the grasp of what you're doing, right? Not that you can't be a great business, but just like, that's crazy, crazy high. Then the fourth is understand your needs. What do you actually need the money for, right? Is it a long-term need? Like, okay, I gotta, develop this entirely new product, and it's going to take me a year to develop the product before I can sell it, right? That's a long-term need. Or maybe it's just something short-term. Like, I just need to, I'm coming up to the Christmas period. I need to be able to spend more on my Facebook ads for this period. It's just an extra 20,000 and I just need it for this month, right? And this, I think, comes back to Tom and Nat's point. It's like, you really got to know, like, what do you, like, what are the metrics of your business? What do you actually need it for? How much is that? map it out, do some analysis to help you understand. And then finally, once you've got those 4, that's when you can go back and look at the 7 options and say, okay, well, which one fits me, right? And hopefully by explaining it today and kind of showing you the pros and cons of each one, you're able to make that decision, right? And so I would highly recommend going through these steps when you're thinking about financing or selecting an option. Tom and Nat, is there anything else that you guys have found helpful when you come to that stage of like thinking about, oh, do we need more finance? How should we get it? What option should we take?
Like, I understand historically, looking at your data is really important to see where you've come from. But I think also something that's skipped over a lot is forecasting and holding targets, KPIs to yourself to keep yourself and your figures accountable as well. So, okay, I need X for paid media, or I need X for Facebook or stock. What do I plan to return by this? Looking at it long term, forecasting off historical as well. Yeah.
Yeah, and I think tailing off that, we as a business have been lucky enough to be blessed with all 7 of those options, whether that's for the good or for the bad. We haven't done crowdfunding, so we've dabbled in all of it: credit cards, personal loans from friends and family, venture capital. That was an expensive one, that hurt a lot, but we've come out the other side. And yeah, I think there's a lot of options out there. Avoid the lenders of last resort if you can, and even the interest rates on credit cards. We understand firsthand that sometimes you just need cash, and you do have to wear those interest rates, which is unfortunate. But all in all, I think, yeah, now, like what you said, Stephen, there's a lot more options coming out. I'm sure some people are wondering, and yes, we are customers of Wayflyer, and we wouldn't be on a webinar like this if we weren't happy with that revenue-based funding model. It does work for us. Again, you have to assess your situation, your business, and what you're trying to secure funding for, but it works quite well for us. We don't recommend going down the path of obviously putting up mums and dads' properties until you're at a point in your business where you're really rock solid about what you're doing. Like, if you're just trying to have a dabble in something, it's probably not worth it yet. You got to validate the business and the idea and the finances behind it.
Yeah, 100%. Sustainability and accountability. And when you can meet both of those in the middle and realize there's no silver bullet, sometimes you do just have to eat shit for a while to get where you want to be.
Yeah, I love it. That's so helpful. It's so helpful to kind of hear like the different options. Like, yeah, right. Like, as I said, there is no silver bullet, right? You guys have used six different options over the course of your the life cycle of your company, and at each time probably they served a different need. Like, you have a different need for your company, different option is available. But hopefully, I think when you're making any decision, like, the first step is you got to know the options that are out there, and you got to know what your needs are, and forecasting. That's another one, right? We could probably do a whole session on is forecasting and understanding the needs that you have for your business. But yeah, that's really helpful, and thanks so much.
But also, coming off the back of that, Stephen, not only forecasting, but also if you've got current debts, like if you've got trade debts or supplier debts, like, just because their terms is 30 days, and hopefully this isn't breaking any sort of laws, but like, if their terms are 30 days and you can't pay it in 30 days, like, yeah, that sucks and that's unfortunate, but have enough courage to have a conversation with your supplier and going, look, I can't pay the bill by this date. This is what I can do. So that also takes a bit of pressure off you as a business owner or trying to secure funding, because you're going to a bank saying that you've got $100,000 owing 2 weeks ago. The first thing they're going to say is, well, you knew that this was coming up. Like, why has it got to this point? Why haven't you faced that sooner? So if you can forward plan, again, the way you spend that money, and some of your suppliers, like, even if you know that they've got room to give, it's aids in your benefit as a business owner to negotiate those terms. Like, if you know you're coming up to that point when it's due, you probably could pay it. It's going to be a stretch, but there's no harm in going, hey, John, I need an extra 3 weeks or 4 weeks to get this over the line. 9 times out of 10 we've found as well that they're fine with that, absolutely, because they've got terms with their manufacturer, or however it may be, their raw materials.
Yeah.
So it's just communicating as well as to where you're at with your funds and where you best allocate them.
Yeah, that's such a great point. I don't think a solution ever comes from just burying your head in the sand and like hoping that, you know, something's going to come up. And as you said, if you know, right, if you can forecast it out, then you can say, okay, well, look, it looks like in 2 months' time, actually, we're going to hit a bit of a tight patch. Now is the time to start looking at options, right? Because now you've got the time to actually shop around, get a good deal, and make sure it's a good fit. If you hit that date in 2 months, then you go, you know, shit, I just need something now. I'm just going to take whatever I can get. And so I think that comes back to, again, having that good idea and not burying your head in the sand and being like a bit proactive about your options, whether that be, you know, communicating to your suppliers or actually going out and exploring your options. I think that's a really helpful tip. Yeah, awesome.
So I have a question that's come through, and I think Tom and Nat, you'd be perfect for this one. You've explored multiple types of finance. You know, some of the finance you just listed, except for the crowdfunding, you said you like tried them all, and there seems to be some pain in as well as the benefits. So can you tell us, how did you know when it wasn't right for you? Was it purely around stage, or it wasn't working for your business? What were the kind of some of the decisions or you know, plans that you weren't able to pursue and that kind of showed you it wasn't the right fit for you at the time? And what was the decision point to try something new?
Yeah, I think the first thing is obviously cash flow. When things aren't adding up, and it's not just about checking your bank account, it's looking at your P&L, your profit and loss, understanding your profit and loss. That's going to be the quickest and easiest way to identify not just cash flow, but like friction points in the business with money or with lending or borrowing even. Everything is in your profit or loss. That would be, I think, the first one. What else?
I mean, yeah, living and dying by your profit and loss is something we would be first and put our hand up. We'll only be a little bit later in the game. Having good advisors as well. So just not being afraid to open up your network and staying in touch with people. Again, coming back to Tom's point of communication, not being afraid to ask the question to people who have been through your similar situation and what options did they look at and why, and then reverse engineering that and applying it to your own situation and figures. Just not being scared of, just talking about it. Yeah.
And kind of just own, like when you get to that point, when you've realized, when you have maxed out your credit card, you have you know, borrowed as much as you can off mum and dad or whatever the case may be, is again just owning it. Like shit, I'm out of money, I need some help. Like putting your hand up. And like one of the times where we came close is Natalie and I funded our own flights and we flew down to Melbourne and we teed up a meeting with a very high up executive, part of a large Australian e-commerce company, and we spoke to them and they said, yeah, come down, let's have a chat. And we literally just guessed their email, said, look, this is where we're at, this is the mistakes that we've made, we'd love 10 minutes of your time, like we'll meet you there. And they actually didn't know that we were coming from Sydney at the time. And when we showed up and they asked, and they were just blown away, and they gave us some really good advice. Sure, again, it wasn't the silver bullet, but it was just the bigger picture kind of story. And, you know, recommended some levers that we could pull and ways that we could, you know, redo it. And we went back to the drawing board and weighed it up. And again, whether that was different types of funding, different types of numbers, wage cuts, all of that, staff cuts, just stripping everything back. So it's just having that other set of eyes across your business, your financials, and obviously being transparent with the right people, not like your mates and that kind of thing, but with people there, you know, that have been there, done that, and they just look at it in a completely different light. You know, like there was times where we were in sometimes a bit of a panic about cash or cash flow or what to do. And you find a sense of calm and talking to sometimes those bigger execs that have managed, you know, multi-million-dollar international companies, and they look at you like, geez, mate, you've got nothing to worry about. Like if this is your problem, like that's not too bad. So it brings it all back to perspective as well. So that would be our takeaway.
Yeah.
It sounds like when you talk about the forecasting and really building confidence is getting into those numbers, not seeing it as just end of month reporting that your accountant or your bookkeeper might help you with. It's really understanding like this is the health diagnostics for my business, and understanding what that could mean for you if you can sustain this. Like Nat, you talk a lot about sustainability, and making sure that your business is sustainable, so you can make the right decisions, that you're not stressed decision making, so you're not holding yourself back or throttling your own potential growth, but at the same time getting comfortable looking at the numbers and feeling like that's a really important part of our business, not just the shiny front end and building out a great product and the supply chain and dealing with customers. The understanding and being really comfortable and confident with finance is a really important part about building out a business as well.
Because then you have confidence in your direction as well. And when you are delegating and growing and trying to build teams, having confidence in your numbers allows you to make decisions, but educated decisions. And there's nothing worse than being in those end of month reports, being delivered reports by your accountants and agencies, and not knowing where you're sitting, what they're talking about. Being able to ask questions, know what questions to ask, and know what targets to essentially tell the people who you're paying to hit, that is where your confidence comes in directing your business and the rest of it.
Yeah, and I think there's also the misconception in many e-com companies, especially, that if you take on funding, or if you anything like that, you have a cash injection, that you haven't done it yourself. You're not that unicorn business where you see on LinkedIn, they've done it from the ground up with no funding, and it's like, look, that's great, that worked for you. It's not always the case for 90% of the other businesses out there, we being one of them. So we were able to learn quite quickly that debt's not necessarily bad. For example, like our partnership with Wayflyer, when we take on investment from them, we're able to then leverage those funds to drive much more growth, where that small percent of the finance, whether it be Wayflyer, credit, whatever it may be, is outweighed by the way we spend that money. And that's where it comes back to, you got to make sure you spend that money sustainably, and you have your numbers, and you have a projection of what that's going to bring in for you. If you don't spend it well, your interest rates and everything else is going to kill you, and you're going to go under very quickly. But if you can leverage those funds and you manage that interest rate as a trade-off to the profitability or the return or the market share that you're going to capture, well, like, you're always going to have to give away something to get something. Like, no one's ever going to give you money and it's just going to be all,
Stephen, we've got a question that's come through for you, and it speaks to, Tom, what you were saying is understanding where you're at and what model works for you, what financial model works for you, and then accessing that smartly. If you're, what stage would Wayflyer be a great fit for businesses? Do you have to be established? Can you be a startup? Can you be pre-revenue? What makes a good fit with the Wayflyer options?
Yeah, so for us to be able to provide funding to a company, we need you to be in business for at least 6 months, and to be doing, probably about $10,000 a month in revenue at a minimum. And the reason for that is because we need the historical, some bit of historical data for us to be able to assess the business and see how you're performing, and also we get paid back as a percentage of revenue. So if you've no revenue, then we don't get paid back. So it just wouldn't make sense for us. But yeah, once we can help. Like, if you're just starting off, if you're just getting going, like, we're, unfortunately, we're not able to help get that first bit of revenue in. But once you've got some revenue coming in the door, you've got a bit of product moving, then we're usually able to help.
Thanks, Stephen. I think there's a great follow-on question around, like, if you are a good fit and people looking to reach out to you, do you build in let me get this question right. When building out a responsive and responsible financial model using revenue-based financing, do you tend to build out the cost of the revenue-based financing into your cost of goods sold? Is it more traditional, or is it like a really new type of financial modeling?
Yeah, so I'd be very keen to get Tom and Nat's view on this, but I think, so from my perspective, there's a couple of ways you can treat it, but the good thing about it is that, we set our cost up front, right? So you know exactly how much it's going to be, right? And you can just put that on your P&L, or, as as an interest expense or as a cost of funds. Or else, you know, if you wanted to, you could work it into your gross profit. But typically, how it's like, it's going to show up in your P&L as an interest expense. And so that would be how I would tend to think about it. But Tom and Nat, you're the guys who actually have to deal with this. So what do you do?
Yeah, definitely. So we factored into our gross profit, obviously coming back to what we said, spending that money on the right channel or the right way. So our funding got split between us. So the model that we built, obviously an amount got allocated to Natalie for marketing and her team, an amount got allocated to myself and my purchasing team here with product procurement, and obviously making sure that we're spending that money on the high margin products. No point sinking funding into a low margin product. Well, no disrespect, if you do, that's fine, but that's where we factored our costs into our margin, because we had enough in that margin to absorb it there. And then Natalie was able to then forecast the sales and the demand for the product that we were bringing in. So it's not as technical as you think. It's literally start just throwing some numbers down, if it's either on the back of a Post-it note or envelope, into Google Sheets, run some numbers, and just kind of see where you stand. Again, people like Wayflyer are also happy to like try and help with that kind of stuff. We found, I think we were across a lot of our numbers before we got to Wayflyer, but I know that the team there have been quite helpful with us with analytics. You know, you're plugging in all your marketing spends and that kind of stuff, your revenue via the Wayflyer portal, which is fantastic. It actually does give you quite a lot of visibility across data points in the business, which is helpful as well. But I definitely think, again, you can ask the right people around you for where you're at, and your unit economics and that kind of stuff. There is plenty out there online where you can get your head around to get the basics, just so you know the conversations that you can have with those people, and then you can dive deeper, and you can do, you can go down a rabbit hole if you really want to, but just try and keep it simple.
Yeah, I mean, all those questions that you Google and questions that you ask, a lot of the time it's just going to give you equations which you pull your figures from. Again, we're circling back to our P&L. So yeah.
Yeah, to answer the question though, we definitely factored into where our profit is in the product. Natalie factors her spend into obviously the return on ad spend. So if she's running it on a particular campaign, she'll make sure that return on ad spend's a lot higher than maybe the other ones that she's got running at the time, or through various channels, whether that be social, email, paid media, all that kind of stuff.
And then when you can forecast your daily sales, then you can take the Wayflyer, you know, fee, the Wayflyer percent of daily sales, and then you can forecast, okay, how much is going to be going to Wayflyer? How much do I now have to bolster my budgets? And that's when you can budget your, say, 20% customer acquisition cost and put 15% of that towards paid media. It's all equations in the spreadsheet if you know your basic frameworks. Does that make sense?
Yeah, it makes a lot of sense, and it's really practical as well. So it sounds like you know, it was a good fit for you as well. It sounds like that it was helpful for your business. It gave you those options, and it also sounds like, Stephen, you know, that the team at Wayflyer really can help with getting you set up and making sure you feel very comfortable and confident that this is a right fit, not just signing you up because of it. So we'll pull together all of the questions that we weren't able to get to today. We've got more sessions coming up, so I really appreciate all the comments and the interaction that we had. We're really excited to kick off these more practical and how-tos, and then really get into uncovering some of the topics around e-commerce operations that, you know, is, you know, often difficult to wade through all those opinions online or great blogs, and you're just not sure which are actually great fit for you. So Tom and Natalie Hinser, thank you so much for adding your real insights. It's always a pleasure to have someone who has done the hard work and to learn from their successes and what they would steer us away from. And Stephen, thank you so much for your time and giving us a great rundown and introduction. We will be getting into more detail as we go on, so this is a great starter. If you are hungry for what comes up next, we will have 2 more webinars on finance featuring the partnership with Wayflyer. We think they're a great resource. If you want to get in touch with them and Stephen and the team, there is going to be a survey that comes up immediately after we connect, disconnect here today, and you'll be getting you'll be able to put in some comments and ask any questions that you were keen on hearing. And if you want to get in touch with him, we'll send across your details as well. I appreciate your time, and you'll be getting a copy of this webinar. So if there is anything you want to go back and listen to, then you'll have that on hand and on demand. So thank you very much for joining our webinar today. We look forward to hosting you again, and enjoy and good luck with building out your business. We hope you do really well.
Thanks so
Thanks,
much, guys, and
everybody.
everyone listening.
Thanks,
See
guys.
ya. Bye.
Cheers.